All right, this is exercise 17-1 out of your textbook on page 1042. And so we've got a casino here, Ferris Casinos. They just bought a property for $6 million with a 6-year useful life and no residual value. The tax depreciation percentages are for the first 2 years are 20% and 32%, and the tax rate is 40%. And they're saying they're wanting us in part A, assuming we have $3,700,000 in income before the depreciation expense, figure the income tax payable, the deferred tax provision, and the income tax expense. All right, so the first thing we're going to do is we'll take the book income and the tax income. So those are the first two things that we need to do. And so we have $3,700,000 in both cases. And in both cases, that includes all revenues and expenses except for the depreciation. So what that means is that depreciation is the only book tax difference, and that, of course, is a temporary difference because eventually it will catch up. And so we need to figure the depreciation. So for book purposes, we've got $6 million. And we're going to divide that by the 6-year useful life. And so we get depreciation expense of $1 million for book purposes, giving us an income of $2,700,000 that we would report to investors. On the other hand, our tax depreciation is going to be the $6 million times 32% for the year 2, and that's going to be $1,920,000. And when we subtract that out, we're going to get $1,780,000 in income that we would report to the government on that. The next thing is to figure out what the tax liability is. So it's 40%. So we'll multiply this times 0.4 and this times 0.4. So 2,700,000 times 0.4 is tax liability of 1,080,000, and 1,780,000 times 0.4 is going to be a tax liability of 712,000. All right. So now our tax expense that we will report on our books is going to be the 1 million. This is the book number, 1,080,000. And our tax liability is going to be 712,000. Now, obviously, we need to balance this entry, and so the difference is going to be deferred tax liability. And that will be for the difference. And that will be 368,000. So the income tax payable is going to be the 712,000, you can write, some people put that as tax liability, some people put that as income tax payable. Probably payable would be better. Let's go ahead and do that. And the tax expense that's what we report to investors on our income statement as our tax expense. And then the deferred tax provision, the deferred tax liability, the way they use provision is it could be deferred tax asset or deferred tax liability, depending on which way it goes. That deferred tax liability in this case will show up on our balance sheet as a liability. All right. Part B then says compute the deferred tax account on the balance sheet at the end of year 2 and indicate whether the balance represents a deferred tax asset or a deferred tax liability. Okay, so now what we're going to have to do is calculate the tax difference. So this is part B. And so in year 1, we're going to have the same depreciation expense of $1 million for book purposes. Again, this will be book. And for tax purposes, our depreciation expense will be $6 million times 20%, and that will be $1,200,000. So what we do is we get the difference here. So the change is 200,000 times 0.4, and that's going to be 80,000. All right. Now, because the tax depreciation was greater than the book depreciation, that means that we pay less tax immediately, but we build the deferred tax liability. So our deferred tax liability in year 1 is going to be 80,000, and in year 2, the deferred tax liability is going to be the 712 that we calculated. I'm sorry, the 368 that we calculated in part A, and we add those together, we'll get 448,000 is the deferred tax liability that we actually report on the balance sheet. All right, so that concludes exercise 7-1.